Intangible long-lived assets are non-physical assets that provide future economic benefits to a company over multiple accounting periods. The program explains that these assets include patents, trademarks, copyrights, franchises, licenses, customer relationships, and goodwill. Unlike tangible assets such as property and equipment, intangible assets lack physical substance but may still represent a significant portion of corporate value, especially in technology, pharmaceutical, and consumer brand industries. Analysts must understand the accounting treatment and valuation of intangible assets because differences in recognition, amortization, and impairment can materially affect profitability, asset values, and financial ratios. Proper analysis of intangible assets improves assessment of earnings quality, competitive advantage, and long-term business sustainability. Intangible assets are classified as either finite-lived or indefinite-lived, depending on the expected duration of their economic benefits. Finite-lived intangible assets have identifiable useful lives and are amortized systematically over those periods. Examples include patents with legal expiration dates, licensing agreements, and customer contracts. Indefinite-lived intangible assets, such as certain trademarks and brand names, are expected to generate benefits indefinitely and therefore are not amortized. Instead, they are tested periodically for impairment. The classification significantly affects financial reporting because amortization reduces earnings over time, while impairment testing introduces uncertainty regarding future asset valuations. Analysts evaluate management assumptions regarding useful lives carefully because aggressive estimates may overstate profitability and asset values. The accounting treatment of intangible assets depends largely on how the assets are acquired. Purchased intangible assets are generally recognized at acquisition cost and subsequently amortized or tested for impairment depending on their classification. Intangible assets acquired in business combinations are separately recognized if they are identifiable and measurable at fair value. Internally developed intangible assets present greater complexity because future benefits are often uncertain and difficult to measure reliably. Under most accounting standards, research expenditures are expensed immediately, while certain development costs may be capitalized under IFRS if technical and commercial feasibility can be demonstrated. These accounting differences can create major variations in reported assets and profitability among firms operating in innovation-driven industries. Goodwill is a unique intangible asset arising from business acquisitions. Goodwill represents the excess of the purchase price over the fair value of identifiable net assets acquired in a business combination. Unlike other intangible assets, goodwill is considered to have an indefinite life and is not amortized under IFRS or US GAAP. Instead, it must be tested periodically for impairment. A goodwill impairment occurs when the carrying amount exceeds recoverable value, requiring recognition of a loss in the income statement. Analysts monitor goodwill carefully because large impairment charges may indicate unsuccessful acquisitions, overpayment for acquired businesses, or deteriorating future profitability. Excessive goodwill balances may also increase uncertainty regarding the reliability of reported asset values and earnings sustainability. The valuation and impairment of intangible assets significantly influence financial statement analysis. Amortization and impairment charges reduce net income and may affect profitability ratios, return measures, and debt covenant calculations. Companies using aggressive assumptions regarding useful lives or impairment testing may temporarily overstate assets and earnings. Analysts therefore review disclosures carefully to evaluate accounting policies, impairment methodologies, and management assumptions. Changes in technology, market demand, legal protections, or competitive conditions can quickly reduce the economic value of intangible assets. Because many intangible assets lack active market prices, valuation often depends heavily on management judgment. A thorough understanding of these risks helps analysts assess reporting quality, operational performance, and long-term business competitiveness more accurately. The analysis of intangible long-lived assets is increasingly important because modern companies derive substantial value from intellectual property, brands, customer relationships, and technological innovation. Traditional financial statements may understate the true economic value of internally developed intangible assets because many expenditures are expensed immediately rather than capitalized. As a result, analysts often supplement accounting data with qualitative evaluation of innovation capabilities, market position, and strategic advantages. Effective analysis of intangible assets improves forecasting, valuation, and risk assessment by helping investors understand the sustainability of competitive advantages and future earnings potential. A strong understanding of intangible long-lived assets enables finance professionals to interpret financial statements more accurately and evaluate companies operating in knowledge-based and innovation-driven industries.